Hey guys and girls, it's Nathan Birch here from the B.Invested headquarters, the home of unorthodox views on finance and property and whatnot, and also the home of the OG property investors and what is a property portfolio. So first, before I get started, I just want to first of all apologise for the fact that I have a cold. I've been really ill the last week or so, and got a blocked nose still got it hard to talk, and haven't had a shave for a week. So I just wanted to address that first. Thanks for joining in, everyone. I can see the comments coming through. Just really want to talk about, I've had lots and lots of people ask me questions about a story that came live last night on Channel 9, 60 Minutes, just regarding the property market, that we're in a crash and everything's going to fall apart and all that sort of stuff. And I want to talk about some of the truths that are in there and some of the things that have been totally spun around and people are getting scared, and what I'm thinking, what I'm doing, and ways that you guys can protect yourself, and probably some ways that you guys can save money and make money in this current property market. So just getting into it. Some of the things that I actually did like about the story is there's one of the people on there which I actually follow and have followed since day one of them being out there in the public, which hasn't been too long, which is the data guy, Martin North. Always pulls up interesting data and statistics. For me personally, I always need to know what's happening out there in the finance market. Just due to the fact that personally I own a lot of property myself and have a lot of debt myself. I have probably more debt than anyone in this country on a personal level. And that's something that for me personally, I need to know how all these things work. And if you guys think back about 12, 18, 24 months ago, everyone thought I was crazy. I made a post on here on Facebook the other day about the fact that people thought I was crazy 10 years ago, 15 years ago, when I bought my first property in 2003 in Western Sydney. People thought I was crazy for buying large amounts of properties. People thought I was crazy when I said that the dollar will die, that all currencies will die. People thought it was crazy when I said that interest rates will end up going to zero over the course of the next decade, and so on and so forth. And we're starting to see those things happen. There's some interesting points raised. There is a debt problem, and I raised this. I called it the GFD. I came out very public about this this year. I've made the 5-part video series on, it's on YouTube. It was a webinar that was a free 5-part series. It take about an hour, hour and a half each webinar. So I encourage you to go to the YouTube channel, youtube.com/Binvested, and look for the 5-part series. They're the only videos that are about an hour and a half long each. We're actually step by step go through my views on what I see happening out there in the not too distant future, which within saying that, there is some pain out there. It all started back in 2016. Well, it started a long time before that. In 2008, we had the GFC, which was exactly 10 years ago. And that's when I quit my job in 2009. And property was the vehicle that got me through that, and went into a very interesting sort of time frame. This time it's very different. In the GFC, it was caused by a housing crisis in the US. I look at property as an investment vehicle. I own a company called B.Invested. It's not called B Property Group or anything like that. That's a fact because I'm an investor, and a property is a vehicle that is my favorite go-to vehicle. And understanding how the monetary policy works underneath, understanding how the whole financial system works inside monetary policy is very important to become successful by using that as a vehicle. And from my investing personally, and looking at what's been happening in the last decade, to get out of the GFC without having big ramifications, basically what should have happened is the bank should have died, the institution should have died, and the people that caused the problem should have been locked up. But none of that stuff happened. And the way out of that was the RBA dropped the interest rates over a period of 5 months in 2008, from August, I believe. Over 5 months, it was at 725 basis points. It ended up at 300 basis points within 5 months. So it was dropped by 4.25% in that period of time. The central banks, which is a privately owned central bank, actually made those rules. which, has printed more money. We've seen money become cheaper. Money became easier to obtain, and we need to stimulate certain things in the marketplace. Over the course of the last 10 years, we've all around the world, we've got a global economy, and no longer is it just Australia over here, or just America over there, or just the UK or any other country. All the countries are working with the same monetary policy. And in short, what happened in 2016, September 2016, they didn't roll over the debt, and there's a liquidity crisis happening globally. From that, I believe that we've been in some sort of recession since then, and that's what I called it. I've got evidence to show that I've had these conversations with those close to me. And basically what we're seeing is just a cause and effect of drying up of liquidity. And this is a pinch at the moment, but I want to draw your attention to a few facts that are out there in the marketplace. And I made some notes on this front, and to be calling that, the property market's in a bubble, is going to collapse, all that sort of stuff. There's a few things that you need to look as facts, and no one's talking about this stuff, but for someone that's been a part of over 10,000 property transactions in the last 10 years, I think it's important that I share my view from real world experience out there on a day-to-day basis. So fact, Sydney and Melbourne have gone up a lot over the course of the last 10 years. Did you realise that Sydney property prices peaked in 2003 and went backwards till about 2008? You could have picked up a house for $280,000 in Mount Druitt back in 2003. By 2008, you could have picked up on a bank repo day special for around 190 to 200,000. So Sydney had a big property crisis then. I didn't see any problems with that. On average, that 280K property was probably about 240K. It stepped back quite a bit, and there was bargains in there to be able to take out of the marketplace. The market had plateaued in 2009 with all the stimulus coming into the market, and the market picked back up from about 2011. It was back to where it was in 2003, and from 2011, it doubled, roughly. In this last 10 years, we've seen Sydney prices go up quite significantly because we had tightening back in 2003. Sydney is a doormat to the country. Sydney is where most migrants come to, and we need immigration because we need people to pay taxes for our Ponzi scheme of a social network and financial network that the government put in place to keep going around. So we need to keep up immigration. So the more people we bring into the country, the more property we need, which obviously puts a pent up of demand to push the property market higher. So I think that, especially looking back in that GFC period of time, we saw rents increase as well as a derivative or something coming from derivative. I don't know why I use the word derivative in that. It must be because I'm sick, but derived from the fact the market was in that position, rents increased. So as a property investor, I drove around with a car that had an unplaced cash flow on it, and that's what it's all about. It's cash flow. What I want to draw our attention to is that in the last 10 years, we've seen Sydney, we've seen Melbourne go up in value. Queensland has not picked up to get back to where it was pre-GFC. Northern Territory has not picked up since where it was at the GFC. Western Australia, I haven't been over there since I was 7 years old, but I can tell you from what I've seen out there throughout my own analysis and data and research is that the market has not hit levels where it was pre-GFC. Adelaide, they're still waiting for something to happen there, so on and so forth. So what we've seen is that there has been a pump in the prices, but to say that the whole property market is overvalued and all that fear mongering and stuff like that, yes, there is some corrections happening out there. Yes, there is markets. There's people that have bought properties at stupid prices. I have called that over the years. Be very cautious of what you buy. Buy based on numbers and not on emotion. Those things here are very, very important. So to say the whole market's overvalued, the whole property market, you need to make up the decision for yourself. The next point that I had is that the market corrects. When a market normally booms, there is a correction phase, so it does get oversold, and we're in that sort of phase at the moment. a lot of fear out there, you know, a lot of issues that people are raising out there in the media. It only started 2018 that the mainstream media started talking about this stuff. If I do recall, I was talking about it getting crucified on social media in 2016 and 2017. You know, people giving me all different sorts of comments and accusations and stuff like that. Yeah, just based on my views of the whole financial market. People are talking about one of the things that Martin North, the digital finance analytics guy, was talking about on 60 Minutes last night was that interest-only loans, you're going to be trapped in a mortgage prison and all that sort of stuff. Yes, I do agree that the finance system is stuffed. There's all the liquidity being sucked out of the market. There's been tens of trillions of dollars worth of debt created globally since 2008 to steer us away from a recession. As of November 2017, they started rolling back by $50 billion per month, by $10 billion per month, and each quarter is increasing by another $10 billion a month. We're now at $40 billion a month, and soon to be in November 2018, crossing the point where it is $50 billion per month. And I expect banks such as Deutsche Bank, you know, potentially to implode. Remembering that what caused the GFC was $7.5 to $8 trillion worth of derivatives around home loan products in the US market. What incurred from that is that there was global issues because those things were dog shit wrapped in cat shit if you had watched The Big Short. What has occurred since then is that everything has ended up into a bubble, and we've seen stuff like education, student loans, retail loans, auto loans, basically loans for everything being wrapped up in the same sort of style. If you go onto Google, and you'll see that Deutsche Bank has already sacked 10% of its workforce. They have $75 trillion worth of derivatives, and they're based upon everything. There's over $1.2 quadrillion worth of derivatives out there in the financial markets globally. So looking at the fact that people are going to be rolling over from interest only to principal and interest, I want to draw something very, very exciting from this. And this is a way you guys, if you do make money out of this video from what is about to come out of my mouth right now, I would really appreciate if you put a post underneath this video to let me know that you saved money and let me know how much you saved. So people are saying that interest-only loans are going to implode the market. If you go on to pick any of the big four banks, go onto the websites, look at the interest rates that are available, variable rates. I'm not a guy that normally fixes interest rates because you're making a bet against the bank and the funding that they're getting at the time. And I have called multiple times that we will head to zero interest rates in the coming short period of time, a couple of years. And people go, but interest rates are going up. Well, you need to understand how the monetary policy works and where money comes from. Sorry, guys. As I said, for those of you that are logging in, I am sick with the flu, very, very sick, but I wanted to get this message out to you. So with the interest-only loans rolling the principal and interest, that is a concern of mine as well. A lot of people don't service because the banks have tightened their policies and you don't qualify specifically to go and refinance your bank to another bank with an interest-only period. However, if you go to those big four banks, look at their websites, they have a fixed period of 2 years or 3 years on there of principal and interest, which some of them are around 4%, 3.95 to about 4.15% interest rate as a principal and interest. But the most variable rates that people are paying as an investor, they're paying around 5.2, 5.3, 5.4 at the moment. So in essence, if you were to revert your loan to a principal and interest, fix it for a period of 2 years, for example, as a principal and interest, you might be paying slightly higher, but you're saving a lot on the interest component and you're doing forced savings. So, and it doesn't really hurt you that dramatically on a cash flow basis. Be aware that if you, and this is not financial advice, if you need help on this, you can call my office or send a private message here to this channel, or send us an email at admin@binvested.com.au and put you in contact with our team at Zinger Finance. If you do fix your loans and you do want to go and sell the property or refinance the property or whatever, you will most likely have to pay a break fee on, the difference in the interest rates or whatever they are at the time compared to what you locked them in at. However, I just recently looked at some of mine and their principal and interest and stuff like that anyway. And I was like, why didn't I fix my rates earlier? But so for me, because I don't have any, capacity to keep going with those banks that are with the big four, which I've already, borrowed debt from in the past. I'm in a position where I'm just fixing them and saving myself some money. And obviously the cash flow is a very, very cool thing to have. So go check that out if you can fix them at a cheaper rate. Another fact about this segment is that the story is based very much so upon opinions and not actual data. A lot of doom and gloom. There were people calling this sort of thing in the last, in the GFC. There's a guy called Stephen Keen. Now, I don't know him personally, never spoken to him, never come across him, but I do remember following some of the things that he had come out with. He said if the property market didn't collapse by 40%, he would walk his way around the country or something, which he nobly did. He also sold his house, I think in 2009. And as a result of selling his house, he missed out on the biggest property boom in history. Basically, the other fact is that the banks will cover themselves. They'll just take the money that they're owed and all that sort of stuff and not worry about the consumer. There is a lot of laws that are surrounding protection of individuals to make sure that they're protected so the banks can't scalp you even though they're ruthless and all that sort of stuff. There is 3 points as to why these things will not happen. I believe, as I said, that Martin North, the digital finance guy, the data scientist, I actually quite well agree with pretty much everything he says. But there's 3 things that he's missing, maybe 4. One is real world knowledge of being out there in the market. Second one is a fact. I'll take this as the first one. The first one is a fact that he has left out quantitative easing. Quantitative easing occurred by putting more liquidity in the markets. What has happened globally, or what has happened with every central bank around the world, is that money has been printed, debt has become worthless. They keep putting more and more money in the system, which is causing higher inflation. It's not the fact that your property has gone up in value. Your property has probably not gone up in value, and the dollar has just bought you less. I've talked about paddle pops and cheeseburgers and the devaluation of the currency for a very long time now. And basically that's what's happening in the property market. Your debt becomes irrelevant with inflation. The second thing, socialism, totalitarianism, fascism, communism, whatever you want to call it, back in 2009, 2008, 2007 actually, we had our friend Kevin 07 come into play, and he donated everyone $900, just give it away. So racked up some debt to the country to, pay for some retail spending and collect it back on the taxes. I call it jerking the dog to feed the cat, to be honest, but just giving away free money. So that was one form of socialism, communism, and so called. But then we saw other aspects of it. First homeowner grant increasing from 7,000 to 14,000. We saw coming out of this, the rules and regulation from overseas to be able to buy in the country, which had gone up quite significantly, which boosted the economy. The stimulus that was given to and incentives to people to buy brand new properties, which increased building and construction in the industry. The fact that monetary policy became very easy. The fact that the cost of money went down in value. So there's lots of things that were stimulating the economy back then in the way of stimulus packages. What we're seeing at the moment is lots of new stimuluses that could come out. Some of those stimulus packages that could come out in the future could be in the way of universal basic income, could come in the form of first homeowner grants and all those things that we've seen in the past, but there could be a whole new swag of them, which could be tax-based, dropping money. Imagine getting your whole tax return for the last year, given back to you. I'd encourage you all to understand how monetary policy works, how currency works, and how every fiat currency that's ever been created has only ever lasted a maximum of about 45 years. The current dollar that we use was created in 1971 by President Richard Nixon in America, and we went off the Bretton Woods system and got stuck on the petrodollar, and that's when our dollar started. The dollar went broke in 1971, and when we went from the dollars and the cents, from the pennies and the pence to the dollars and the cents back in '66, was a changeover of a currency, and it's been dying since the 1980s. So it only lasted 10 years before it started its downward spiral. Go look at interest rates over the period of the last 40 years, you will see that the dollar has been dying. The interest rates can never get back to the level of where they hit as a high from the time beforehand. And the important thing that I was talking about in those fixed interest rates, never before in the 15 years of my personal property investing, and I only realized the other day, it was 1998 when I was 13 years old, getting sticky pages in those post-pictorial magazines that were out there, getting excited by property. That's 20 years ago. In 20 years of researching property, I've never seen a fixed interest rate in an interest rate increasing environment be less than the variable rate. So just think about that. If you're making a bet against the bank on fixing interest for 2 years, and the interest rate is 1% or 1.5% lower, what direction do you think the interest rates are really going to go to? So that's my view on it. The other aspect to think about it is all of the parties that are invested into the property market, the economy, and keeping this system alive. If property prices were to drop by 20%, a lot of the loans that were written in the last 5 years, the property market probably peaked in 2016 and come off since 2016 by a period of maybe 5%, maybe 10% in some areas. But if the property market was to lose more than 20%, that would mean that that would take us back to about 2014 prices, 2013 prices. The banks, for every loan that they would have written past then, that even had a 20% deposit put down on them, they would be in negative equity at the bank level. The banks, which are basically the controllers of the world and the people that control the government and all of that sort of stuff. Look at the Banking Royal Commission at the moment, which didn't want to be enacted because, you know, that's the bosses of the government, is it? The reality of it is these people that have so much power, you want to see them crash their asset value. You want to see them remove all value and then be in a vulnerable position. What are they going to do? Sell your house and have less money back on the table? So at the end of the day, these institutions have a business to run. I've talked about having 3 things that are very important. Buying your property below market value. That gives you a buffer and also access to equity so you can buy more. Talked about buying it with upside for capital growth because you want to see capital growth. Property only get rich quick scheme. I've been in it for 15 years. I've been investing in it. I sacrificed my youth for it. I didn't have a face full of grey hair when I first started doing these videos. It's a long-term strategy, so you want to make sure that you've got upside for capital growth. You don't want to be buying properties with taking a gamble on it because that will cause, you know, a risk associated with your investing. The third one, and it's the important one, is making sure that the cash flow is strong, a positive cash flow, neutral cash flow, whatever sort of cash flow, to make sure that doesn't matter if shit hits a fan, you lose your job, that your properties are going to look after themselves to get you through any market cycle. That's my view on it. Am I still optimistic about property? I'm very optimistic about property, and I'm in the process of looking to purchase some more properties. I have been buying properties every year since the date that I could sign a contract at the age of 18, and I like times like this because this is when the money goes from the weak into the strong hands, and this is evident of it from everyone getting scared because the TV said so, that you must obey without questioning what they say on the TV. I did have a few other little notes here. Yeah, with it, I'll leave them to the side because I'm noticing a lot of questions. There's lots and lots of deals that are happening out there at the moment. There's lots and lots of things that are there are opportunities out there. So I can't actually see all of the comments here. I'm trying to get through them. So I'm going to start from what I assume, or maybe I might go to my phone and check it out. So let me just go and check it out from another source, if this will allow me without any interference from our camera here. I see a lot of handshakes and highs and stuff like that. But keep the questions coming and I will be to them in a second. Stuff like that. Well, but keep the questions coming and I will be listening to myself on this phone. A lot of thumbs up, smiley face, thumbs up. Gurks, if you had a crystal ball, can you name your top 3 pros and top 3 cons of what will happen in the Australian property market in the next 10 years? Good question. The top 3 pros is that there will be still a lot of opportunities out there. We are a young nation. We don't have enough housing to accommodate for all those to arrive in our country to work as a part of the tax slave position that we all get indoctrinated to at school. So it's still going to be a strong demand for people to want to be a part of buying property and whatnot. There's going to be lots of wealth being transferred over the next 10 years. There's going to be opportunities with deals. And I personally think that what we're going to see is the dollar dying. And with the dollar dying, it happens. Like, it's not me making it up that dollars die or currencies die. Fiat currency, the word fiat currency is fake. It's made from nothing. It's a currency that's not backed by anything. They used to have to make coins and fraudulently make coins to water down the value of them. Then they used to print notes, which were IOUs, and then they stopped redeeming them for gold. And then after that, what they did is that they didn't even need to print anything. They just put digits on a screen and just add an extra decimal place and add value into the currency system. Now, the first fiat currency was in 1024 AD, which was 1,000 years ago almost. Since then, there's been over 10,000 fiat currencies, and they've all eventually turned to a value of 0. Look at Argentina, look at Venezuela, look at Zimbabwe, look at Turkey, look at India, look at Brazil, look at Australia dollar. The Australian dollar's dropped by about 15% this year. All the currencies are dying. In 2008, it was fraudulent companies and institutions that went broke and went under. In 2018, it is countries and currencies which are going under. And as the currency dies, they always get inflated. Debt becomes irrelevant with inflation, and that's where I see the biggest opportunity. But that's a little bit complicated on that front. So I've got my eye twitch. As I said, I've been sick for those of you that are tuning in. So I've just got an eye twitch here. Some of the cons, you're still probably going to hear these people whinging. 12 months ago, they were whinging that, they can't afford to buy property. Now they're whinging that the sky's falling in. I've heard this stuff for 15 years as a property investor. I remember getting laughed at on TV for being told that the properties that I was buying I was going to go broke, and I remember being told that I'm greedy because I've bought too many properties. So you're going to hear the same negativity out there. You're going to hear the same cycles. The same things that are happening today have happened way many times in the past. So I've got some more questions here. Rick, you still built your empire before you learnt all this. Rick, yeah, true. Built my empire of properties and whatnot before I learnt this. However, having the knowledge has what's been able to push me forward to understand how everything works and to be able to push forward for the next level. And this could be an interesting quote for all of you, and no matter what stage you're at in your investing or journey or life or where you're at or where you're feeling at the moment, is that each new level brings new devils, and it requires new skill sets and a new version of you. So, the knowledge is really important out there. Tristan, personal credit card, house out corporate sovereign debt is out of control globally. Big offshore speculators, investors are lining up to short the big four banks. Tristan, I would probably agree with you on that. I'm not invested in the stock market in any capacity at this point in time. Doesn't mean that I don't buy stocks. I just don't like them that well, and I'm not investing in them at the moment. But I'm in a position to actually short them, and I am in the process of starting to short the banks. The questions here from lots of people, or comments, sorry. Hit me with some spots on the gold. Pete, hit me with some spots on the Gold Coast to buy. Everyone always asks me where's the best area to buy property at the moment. I personally do like the Gold Coast. I like Brisbane. I do pick up lots of bargains. I've picked up probably 40 in the last couple of weeks for my clients in those markets. It's not about where to buy, it's about what to buy. And what to buy is what's discounted, what's of good value, what's below replacement cost, and what has a strong cash flow to it. Lots of cool faces and thumbs up, so I'm guessing you like what I talked about beforehand. Jessica, which suburbs would you invest in and why in Sydney? As I said beforehand, it all comes down to the numbers. Am I against Sydney? The question I ask is, whilst everyone is getting, scared of the market and running and thinking that everything's going to cave in, that's when you want to go on with your facts. You want to take these facts. You want to take the facts of what's happening out there in the marketplace and use them as your disposal to be able to knock people down in prices. So, with where to buy in Sydney, I like the blue collar areas, but I've invested all the way from Vaucluse to Mount Druitt and beyond. So, as for a specific area, it all comes down to what you need in your portfolio at the moment and what is a part of your strategy. Chandra, how much further of falling price for Sydney do you reckon? As for price falling, I don't have that crystal ball. I believe that we will see falling until we see quantitative easing happening again and the socialist sort of programs from the government via stimulus. I don't know how long. I personally believe we're right on the eve of seeing some large institutions collapse. We're starting to see currencies and countries collapse. It only takes a mark-to-market action on the stock exchange, on the stock markets to occur to cause the need for stimulus to come in the market. When the stimulus comes in the market and arrives, what we will see is these positions will change. So, I personally believe we've seen in some areas 10% falls. We may see another 5. We may see some bank repos. What is different in this market than previous markets is we don't have the interest rates going up. We're stuck at 150 basis points at the RBA. And the reason being we're stuck at 150 basis points is because if our economy was good, we'll be pushing the interest rates up. We are seeing the rates of the banks go up, and that's because the cost of borrowing has gone up on that front. So do I see them coming down? Quite possibly, but make sure that you do take advantage of the opportunities. I've got a lot of questions here. I've got a lot of questions coming through. Well, what I might do is let's have a look here. What I'll do, keep your questions coming through and I'll answer them over the next 24 hours. But yeah, with it, I can see there's 52 comments here. I really appreciate you guys joining in. I don't want to waste too much of your night. It's probably past some of your bedtime, but I do really want to jump on. I've had a really busy day. As I said, I've been crook. I just wanted to get out there, share my views, share my thoughts. All of this knowledge that I'm talking about at the moment, I've been talking a lot about this over the course of the last 12, 18 months. Some of my investors here and my clients, I've built a property investment mentoring program to help warn. So basically every week when I do my mentoring sessions, I run through all the news out there in the marketplace and spend about a half an hour to an hour on the news, reinterpreting what I see, as well as choosing specific topics on what I talk about on that front. So if you do need help on that front, you want to push your investing to the next level, I'll put the link in the description as well for you to be able to join up to that mentoring program and be able to keep getting the content of what I talk about to really take advantage of this current property market and not just survive, but to kick ass and make profits. So we'll catch up soon. Thanks for tuning in. And I'm going to go get some rest because I still feel like crap. We'll catch up soon. Bye for now.